This is Isaac Morehouse. Welcome to the podcast where we discuss education, entrepreneurship, big ideas, how to put them into practice in the real world, and above all, how to live free. This episode is brought to you by Praxis, discoverpraxis.com. Derek McGill, who was interviewed on an episode from season 1, dropped out of the University of Michigan. He went from the dean's list to leaving school. Why? Because he was bored. Not because it was too hard for him or he wasn't good enough for an elite school. It just wasn't good enough for him. It wasn't bringing him what he wanted. It wasn't worth it. The prestige and the pleasure of others that he was there, not a good enough reward considering the life that he wanted to build. He quit. He joined Praxis. He's a digital marketing guru, all self-taught. After being in the program, we liked his work so much, we hired him on as our marketing director. Derek is one of many examples of young people today who are realizing the world is changing. It's changing fast. There's more opportunity than ever to be your own signal, to be your own credential, to create things and demonstrate your value creation potential through what you've done in tangible ways. Build a website, build an online presence, get work experience. Don't worry. It sounds overwhelming, but you get all of that in the year-long Praxis program. It's not easy, but no great adventure is. discoverpraxis.com/apply. You can join Derek and many others in building the education revolution, starting with your own life. Who are some of the young people that attend fee seminars, the Foundation for Economic Education? Looking at some of the alumni, there are a lot of people that you probably think, hey, that sounds cool. I want to do that. Stephen McCaskill is a successful entrepreneur in Denver, Colorado. Lana Link is the director of communications and marketing for the Moving Pictures Institute, which is a phenomenal organization aimed at getting great videos, great short films, feature films produced and supporting the producers of those films who care about the ideas of individual liberty, human flourishing, and freedom. Speaking of the arts and entertainment industry, Robert Anthony Peters, who is an actor. Bob Ewing, who is the director of media relations at the Mercatus Center, a think tank in Washington, D.C. There are people from every industry that you can imagine in every part of the country who have gone through fee seminars when they were younger. And most of the time, I know personally in some of these cases, I know in the case of Bob Ewing, for example, who, by the way, is a co-author in one of my books, Why Haven't You Read This Book? Bob is the author of one of the chapters and really was instrumental in the concept of the book. Phenomenal guy. When he was young, it was a fee seminar. It was the Foundation for Economic Education that got him turned on to the world of ideas, excited about the concept of human liberty, and that has guided him and led to a very successful career. I believe he interned at FEE, actually, if I'm remembering correctly. So it's a great history of going to these seminars, being changed, meeting amazing people, being introduced to amazing ideas. And they don't just come and go. It's not just a hit, one-time experience where you take a hit of fun. It stays with you. The network of alumni stay with you. The faculty you meet, they'll stay in touch with you. I'm in touch with participants that I've met, seminar attendees I've met from years ago. In fact, one of them works for me now. More on that in another episode. FEE.org/seminars. Fill out an application. Tell them you heard about it on the Isaac Morehouse podcast. Welcome back to the podcast. This is part 2 of our 4-part series, A Beginner's Guide to Startups. And today we are going to be talking about investors, what types of investors there are, what do you need to do if you need to seek investment, all of the various elements involved there. And joining me is Michael Gibson, who has been on the podcast before. In episode 27, it was in 2015, if you want to look that episode up. And he talked a lot about his own personal story and bio. But suffice to say, for today's purposes, Michael is a general partner in the 1517 fund, which is a venture capital fund. And he has been around and seen quite a bit from the investor side of the table, and that's what we're going to discuss today. So, Michael, thanks for joining us.
Great. Happy to be here, Isaac.
So in episode 1, we talked about, or in part 1 of this series, we talked about, once you have an idea and you've got sort of a business plan, you've got a clear understanding of what you need to do to bring your product to market, who your customers are, et cetera. And then you get to the point where you realize, and not all, and we'll talk about in part 3, companies that don't need to raise investment, not all do, but if you realize you need to raise some money to do this, what do you do next? So I wanted to ask you first I'm going to list, and you tell me if this list is accurate, sort of the categories of investor as I see them. So you've got friends and family, which is usually a really small amounts if you need $5,000 or something to borrow from, Aunt Bessie. You've got angels. You've got kind of in between angels and venture capital, maybe you have the incubators and accelerators, which are kind of programs that sometimes come with money. And then finally you have venture capital. And that usually is the goal there is to lead to some kind of acquisition or a public offering. Is that roughly the categories?
Yeah, that feels like a very accurate taxonomy of the ecosystem for sure.
So let's say you've got your idea, your business plan, you need to get going. Where do you start?
Great question. I guess it depends on the nature of your business and what your needs are. It'll be interesting is figuring out whether or not you should be listening to the next podcast or this one is an important question. And so what the difference there is, there are some businesses that are very successful by any measure, but they're just much smaller. Let's say they serve a smaller market it could be tied to geography or even a nation. But there's a different type of company, like a tech startup, that has the ability to scale to a global market or just really big markets. And so if you've decided you're that kind of company or have the potential, and that's what you're aiming for, then you're much more likely to want to pursue funding from the ecosystem that you just outlined.
So would you say in order to decide, yes, I need to go get outside investment, there's got to be a component of a lag between you've got to build something, whether it's the product itself, a process, whatever. And there's going to be a lag between when you build it and when you bring in enough money to cover your costs. But you're confident that if you can cover that lag, you'll get to a point where you're profitable 1 year, 2 years, 3 years out. So it's kind of something that requires, significant upfront cost before, like a delay between the cost and the revenue. Is that kind of?
Yeah. So I guess, where do you start? It depends where you are. The means of production are so cheap now that two people with laptops in a dorm room can start a company that maybe doesn't have revenue, but has, let's just say it's a product that tons of people start using.
Well, so that's on a tech side. Yeah. Maybe I'm just stupid because I don't code.
Yeah, right.
What is it that makes so many of these tech startups need, or maybe they don't need it, maybe the investors just want to be a part of it, but what do they do with all this money in the early stages because they don't have a lot of physical capital? So what is the money primarily used for if you don't have a lot of physical things you need to purchase if you're a tech startup?
Yeah, the number one cost is labor. Okay. Yeah, so typically what happens is if it's two people and they develop some hot app and they're getting tons of downloads, they're going to need to spend money on infrastructure. That could be Amazon Web Services to host them, all that kind of stuff. But the number one cost is going to be labor. First, to cover the costs of their own living expenses, and then also making the first few hires, engineers. Those salaries are going to be really high because you're competing with Amazon, Facebook, Google, the big players who offer very safe jobs and very cushy salaries. So it's a lot of the money goes towards that, and then beyond that, it'll also be some fixed costs or infrastructure spending on office space and equipment. But I want to take it a step back though and say, there is this narrative that a lot of the best companies raise money, and that's just the standard course of things. And you're going to need money to launch your business, no matter what kind it is. But it's always important to remember is like Bill Gates is a great story because Microsoft only raised money once. I mean,
Wow.
think of what an aberration that is compared to today's market with all these private unicorns that are raising round after round of financing. Like Microsoft raised money once, and so there's a reason Bill Gates is the richest man in the world, and it's because he retained ownership, quite a bit of the ownership of Microsoft, because they didn't have to raise money. They were making hand over fist millions of dollars selling their product.
Hmm.
So it's like there's a standard narrative of a tech startup where maybe they start with some money from friends and family, and they're at the prototype stage, and then as soon as they get some users or some revenue, maybe they can raise some money from angels, or they enter an accelerator program like Y Combinator, and then from there they see even more robust growth, so it justifies raising another round of financing from venture capitalists. Like that's the typical story, but there's nothing essential about startups or fundraising that suggests that must be the path. And I always think of Microsoft as a great counterexample
Huh.
because uh, it's pretty astounding. And then even Apple, for that matter, was making tons of money before they IPO'd, which is very different from a lot of the companies today, and that's why they raise money. Is that so? You see this sometimes referred to as a J curve, and the curve on a graph would, like, the x-axis would be time, and the y-axis would be revenue, and it's a J because it sinks down below zero. You're not making any money. You're spending it. You're burning it, in the hopes that in year 1, 2, 3, 4, 5, you come up into the positive.
So, yeah, that's interesting because I think there is something in the atmosphere right now in the air that it can almost it can almost make young people feel like the customer is the next investor, and they
Yes,
just
yes,
start thinking,
exactly.
hey, let's see if we can convince somebody to give us money to sort of goof
Yeah,
around and build this thing, and then if it works there, we can get some more money, and you sort of
yeah,
forgetting like, okay, we do want revenue at some
yeah, right.
point. um well, so what would you say in terms of the getting started?
Yep.
Let's say that we've got somebody listening who's got an idea, and they've
Mm,
put a little money on their own credit card or borrowed a little from mom or dad or whatever. They've sort of
yeah.
that friends and family. When is the point when you sort of consider that angel investor? And let's say you want to
Mm,
meet an angel investor, you want to have a
yeah.
good pitch for them. How do you even go about that?
Yeah, that's a great question. I mean, the key on all this, I guess there are two pieces to it. One is relationships are everything. So even before you're at that point where you decide you need to fundraise, it's best for you to start cultivating relationships with people who are investors or who know investors. And that can mean you better start attending conferences, or any kind of venue where you might bump into these sorts of people. And then the second element of that is, uh, it's sad to say, in the sense that you always have to be hustling, but it's true, is you always need to be pitching. So it's not the case that you're carrying around a slide deck with an outline of the business, but you should always have some sense of what it is that you're building and how you can excite people about it, and some story about why you're involved and you're dedicating your life to this. So with those two things, elements in hand, is like, you reach this point where you decide you need to raise money, then you start sending out the emails to the people saying, hey, I'd love to pitch you on this idea. um, Now let's take the example, though, where you don't know anyone. I think the best route for you at that point is probably one of the accelerator programs. They have open application periods. Anyone can apply. You don't have to know anyone involved, and so that gives an advantage, or helps you out if you have no connections. The next thing I would do is, cold emails are really hard. I think you're going to have a low hit rate. It's going to be really hard to get anyone's attention. I honestly think the best move after that might be really just going back to the conference idea, that any sort of events where you might bump into someone and you can give them a short elevator pitch. I would think about moving to some place where there is capital.
Yeah.
So that could be either New York or San Francisco, but certainly other cities as well. And then, it's the fundamental truth, though, is it's all about, you gotta know people, because it's just so hard to get a meeting unless you know them. And if you visit a venture capital website, or you find an email to an angel investor, it's going to be really hard to just get their attention. I think it's pretty much the policy of any venture capital firm that they won't look at anything unless someone has referred it.
Yeah.
So when I was working for Peter Thiel, sometimes I'd go to events with him in public where he was speaking, and afterwards he'd get mobbed. I mean, people would want to talk to him, and they see it as their shot to, hey, I get a chance to like get 2 minutes with Peter Thiel. I can pitch him something. And Peter, what he would say to people is, I think what you're doing is great, but here's what you need to do. Become friends with someone that I'm friends with, and if they're willing to vouch for you, then I'll take the meeting.
Yeah.
And I think that's, I don't think that's unique to him. I think that's pretty much true of a lot of investors.
Most people aren't helpful enough to tell you directly that that's what you need to do, but but I think it's true. It's funny. I like to use there's a verse in the Bible, I don't even remember where it is, about treat everyone with kindness if a stranger comes, because you never know, and you might be entertaining angels. And I like to use that whether the investor or any other variety, because most often you are only a few degrees removed from potential investors that you may not even know. And I had a friend here in Charleston when I first moved here who I met just at some with some music stuff and whatever. And he met somebody at Starbucks because he spilled his coffee and helped the guy clean it up, and they got to chatting, and then they'd see each other there. And he tells me, oh, he works at this marketing firm. You guys would like each other. So the three of us went to lunch just to say, hey, he knew another guy who owned an investment company. And I introduced him to somebody I knew that was raising money that was friends with me. And long story short, it was like they introduced him to two other investors, and he was able to raise some money. But this is all because somebody helped a stranger clean up coffee, right? So like, that's incredible. It really is. It's you're more likely to get somewhere with someone that knows someone in some way. So that's great, and that's why it's important too to have in mind that you're going to raise money down the road, or potentially. Even if you aren't now, because if you're looking for these opportunities, you kind of sense them out a little bit better in unusual circumstances than you would otherwise would. It's kind of like if you think you're lucky, then you tend to have more lucky things come your way. It's like that antenna is up, and you're just, you notice it. And you're if you kind of let people in your network know that you're raising money, who knows who they might know. So let's talk a little bit more about these accelerators. I guess maybe they're not called incubators anymore. That used to be used more often.
Yeah, I think an incubator is usually just an office space where your company is allowed to work in it, sort of like co-working, and over some extended time period where you're sponsored.
Okay.
Maybe there's some mentorship involved too, if they have people on staff. I think that's the definition of an incubator.
And an accelerator is, and most cities now have these. Y Combinator is probably the most famous, but it's essentially you apply to get in, and you and X number of businesses get accepted to like a class, and maybe it lasts 3 months, maybe it lasts a year. They're different, and you usually get some amount of money. Maybe it's $50,000, and your goal is to get your startup from basically where it is now at raw idea or maybe prototype stage to the point where you can be pitching venture capitalists. Is that fairly accurate?
Yeah, that's a great description. I think Y Combinator, they set the standard. So their program is 3 months, and they have weekly dinners. Their partners will take meetings with you to help you brainstorm on any sort of questions you have to build whatever it is you're working on. And then, it culminates in demo day. And that idea is you've built up your product, you've got some traction, and now you're ready to raise what's called a seed round. And Y Combinator fills the room on the last 2 days with a lot of Silicon Valley investors, and you get 2 minutes to pitch them. I think most of the other accelerators probably follow something along that line, where it's some sprint to a demo day where you're pitching investors.
What should someone be thinking about if they want to apply to an accelerator? Are there any sort of red flags, or what are the people in your experience running accelerators? I've heard this, and it sounds like it's probably true, but maybe it's overstated sometimes, that the person is more important than the business or the idea, that they're investing in a person.
That's right.
Yeah.
So
go ahead.
I'll just dive in on that. Is at the earliest stages of a company, the risk is at the highest point, because all sorts of things could fail. It could the product might not work. There might be no market. The team could blow up. There are any number of problems that could prevent a company from doing well, and so therefore the investors and anyone evaluating the opportunity, what do you have to go on to know if this is going to work out? There are no financials at that stage. There's no, maybe there's a little revenue, but is this something that can scale? It's a lot of uncertainty at that point, and it's irreducible. So what people focus on at this point, and these are investors, incubators, accelerators, and actually even first employees, or even your co-founder, right? Is like, if you're asking someone to join the company at that point, that's an investment as well. They're staking their career to join forces with you. And so what is the story that you tell? And the number one element in all of these at this early stage is, who are you? What makes you, if you're a team, I mean, at the company point. So if you're applying to Y Combinator, or you're looking for investment, is like, who is this team? Do they have the knowledge to build what they say they're working on? Do they have the cohesion to withstand the ups and downs and inevitable, like, cratering and soaring that is involved with a startup? Do they have the ability to make hires? Are they agreeable? Do they have social intelligence? Do they have the ability to raise money? Can they tell stories? Can they persuade? I mean, so it's like it's all focused on the team. And the thing with accelerators is that this is all based on an application. So it's very hard to suss those things out in questions. That's best, shown over time in reality. So with Y Combinator, what you'll see on their application is they'll have questions like, tell us about a hack you built to get around some system, or tell us about a hack that had a great magnitude, tell us, and had nothing to do with a business, right? So it's like, I think they're asking all these indirect questions because they want to kind of zero in on the character of the people involved. And that's true for the accelerators, and it's true at the investment level as well. So and that's tied to the risk of it not working out. The only way it's going to work out, the thing you have to zero in on, is this team capable of pulling this off? And so that's the number one thing. So there are three things people look at when they're investing at the earliest stage, and team is the number one priority. The second thing is the market that people are entering in. And then the third thing is the actual product idea in that market. And so why in that order? So the team is most important for the reasons I outlined. The second thing, the market, it represents the opportunity that this investment might yield. And that's important when we think about the different kinds of investors. So if you're an angel investor, the source of your money is your hard-earned dollars, however you made your wealth. It could be these people could be high net worth individuals, former entrepreneurs, but whatever the case may be, it's their own money. And so if they're making an investment, think about the alternative investment opportunities that they have as individuals. They could put, let's say, that $100,000 into the S&P, a mutual fund, tracking fund. They could put it into bonds. They could put it into all sorts of asset classes that have a return. But instead, they're choosing to put it into this risky class because, well, it's high risk. There might be high reward and all sorts of other reasons. And so, $100,000 from an angel. Let's say your company at the investment is worth $1 million, and they're putting in 100,000, and that means they own 10% of the company. And let's say that company grows to $10 million. That sounds like a lot of money to you and me. And to the angel, that would be a great return. That's 10x. So their $100,000 is now worth 1 million. And that's better than anything they're going to get in any alternative asset class. There's no way you get that return on the S&P 500. So that's great. However, now the reason I outline that is because venture capitalists are very different because they get their money from a different place. They have their own investors who have pooled money and have invested it in the fund to look for a return. And so now there's a different set of incentives at play and a different business model, such that the 10x return that the angel saw, because it was his own money and he gets all those returns, that's great for him. But for the venture capitalist, let's say he raises a big fund. He's managing $50 million, and he makes that $100,000 investment. It goes 10x. The company's 10 million. It's acquired. And the venture capitalist makes 1 million, that means he still has 49 million that he has to make up in his other investments and before he ever makes a profit for the fund. So by that like rough model, whenever a venture capitalist is looking at a deal, this is why the market is so important, because they're going to want to know that it's going to be bigger than a $10 million company. Because venture capital is very risky. It tends to be a portfolio-based approach, meaning you make lots of investments in lots of different categories to try to spread your risk. And there's a power law return distribution such that it's so risky, only the top 1 or 2 companies does extremely well. And the rest
in a given investment, and they call it a vintage, right? When you have a bunch of, let's say you've got a certain amount of money in a fund, 50 million or whatever, and you're investing that in this portfolio of companies. Typically, it's going to be 1 or 2 of those companies that's going to generate almost all of the returns. So there's that power law you're talking about. Right. So what's the percentage in a typical VC firm of companies that are winners, I guess, or winners is significant?
I haven't seen any public documents about this. I just have my own experience from Peter, working with Peter Thiel, and then just word of mouth around. I mean, I've heard anywhere between like 40% of the portfolio will go bankrupt or fold. Another 40% will break even, and then maybe 10% will do kind of okay, and then the last 10% will either be it has to be the home run that just outperforms everything else by a wide margin.
So that's a huge, from the investor standpoint, I think it's easy for an entrepreneur who's seeking funding to feel like the investors, they have all the power. They're just sitting back with their monocle and their cigar, and they're just having a good old time. They can make people's dreams come true. But the amount of pressure and how much work, like they've got to pick winners, and not just pick, but they've got to actually pick them and also groom them and cultivate them and work with them. And it's very, very, very hard to be successful as a venture capitalist.
Yeah. So I think 80% of venture capital firms break even or lose money.
Wow.
Themselves. So it's only the top firms that are doing really well. So it's a very risky asset class. But I think a lot of investors like to participate because it can be exciting. You're learning about cutting edge technologies, and there is always that chance that you could just find the next Apple or Microsoft.
So there's a lot going on.
I tell people this kind of blows this does blow people's minds when I tell them sometimes, but I keep mentioning my former boss, but like Peter Thiel has to fundraise. I mean, people just think he's this billionaire and he's investing his own money, but if you look at his venture capital vehicles, they have to fundraise from LPs just like everyone else. Yeah. And so accordingly, they have a business model and a set of incentives that are very different from even Peter in his younger days. So when Peter made the Facebook investment, he did that. Founders Fund didn't exist at the time. That was done through his personal office, and it was an angel investment. So I was like, that's a very different situation that he faced than he would now, being the founder and manager of Founders Fund.
Well, everything successful in the world of business requires sales. You can never escape selling.
Yeah, no.
Yeah, actually,
you can never escape selling, and the best sales is hidden.
That's actually a great. We have to come back to that. Yeah, but Michael, before he came on this call, he said, "Hey, I'll be there in a second. I'm just coming from a pitch meeting." I said, "Oh, is somebody pitching you for investment?" He said, "No, I'm pitching other people. I'm raising money." So I want to ask you about there's sort of a big.
There were a couple threads there, and I just want to close on the one, which is like, knowing who you're pitching to is important, because now based on those business models I just elaborated on at length, is like a venture capitalist might pass on you because it's too early for that person to tell whether or not you're a big enough opportunity to make back their whole fund. So if you're talking to someone who runs $1 billion venture capital fund, they're looking at you as a company. They're going to have to figure, it's like, okay, if we get a 10% stake in this company, is it going to be big enough to be worth $1 billion? Think about what that means. That means they're looking to see if you're building a $10 billion company.
Yeah.
Like, whoa. Okay, that's crazy.
There's a huge opportunity cost to their money. So you could say, hey, I've got this business. Look at this model. In 3 years, with $100,000 investment from you, we're going to be a $20 million company, and you're going to have 10% of it. That's $2 million. This is going to be amazing, and that's a good, solid business model, but not necessarily juicy enough for a venture capitalist.
Right? I mean, yeah, exactly. It's like, if I created a $20 million company, I would be pretty proud of myself. That's quite an achievement. But I love that in Silicon Valley for the main, Sand Hill Road VCs, it's just not an opportunity that they're interested in because it's too small.
So angels, there's a lot of growth in this area, and there's also a lot of new ways to access angels. There's kind of things like AngelList, and these sort of crowdfunding kind of things are coming up on the scene. There's a lot of sort of warnings you hear from people about angels, and now certainly venture capitalists might warn people about angels because maybe they have their own reasons for that. But there's a lot of people say there's dumb angels and smart angels, and dumb meaning they basically bring money to the table and that's it, and maybe that's okay.
I've actually heard a new term I've heard a new term on that I prefer because it's a little nicer. It's that they're quiet money.
Okay. All right. That is much nicer. Yeah. Because it's not necessarily bad. I mean, if you.
Yeah. It just means they don't have other services or advice to offer. Dumb money sounds a little mean to me sometimes.
So. No. And I think sometimes, there's if you say, we want money, sort of smart money, somebody that knows the industry, they bring something to the table. You also have to be careful there because that means someone's going to be up in your business all the time. And that might make you better, but it also might drive you nuts.
Yeah. I mean, it might be helpful actually to outline, who can be an investor.
Yeah. Why don't you do that?
So like taking that a step back is, so there's a lot of regulations here. That the SEC, I forget the origins, I think it goes back to the 1930s, but the intent behind it was to prevent snake oil salesmen from raising money from hopeless grandmothers and just defrauding them. What the SEC decided was that if you were rich enough, then it meant you were probably smart enough to know how to invest your own money. And so they created these rules. They created a term called qualified investor. or accredited investor. And an accredited investor has to satisfy two categories. One, that person has to, actually, it's an either or. They have to either have more than $1 million in liquid assets, meaning assets that aren't homes, let's say, that's illiquid, or they have to have made, I think it's 250,000 per year over the last 3 years, and expect to make that in the years ahead. And if you are so qualified, you count as accredited, and you are allowed to invest in early stage private companies. If you don't satisfy that requirement, then Uncle Sam, unfortunately, has said you're not smart enough to know how to invest your money, and you're not allowed to make these investments.
Now that's potentially changing. Is that right?
Yeah, and so I forget, it's called the Jobs Act was passed, included some legislation about changing this policy, but to me, I don't know if the SEC has implemented it yet. Okay. And why that can be exciting is because it's tied to some of these alternative routes of raising money that you might have been inching towards, which is if they allow non-accredited investors to, or they accredit it, everyone, then suddenly crowdfunding becomes an option, or other sorts of ways of raising money from people who might be, have some money they want to risk on this kind of venture, but don't have access right now.
So right now you could go support a crowdfunding campaign for, like, say, a nonprofit or something where you get no stake in the company. Maybe you get a product in return from Indiegogo, Kickstarter, but this would actually allow you to, put in $1,000 and get some small share in the company itself. If that ever changes, if that law ever.
Yeah, it'd be good. It'd be good to check on where that stands. I know it's supposed to happen at some point, but it remains to be seen how it's going to work out. AngelList is they do have a crowdfunding option where people can make investments alongside syndicate leads. So Tim Ferriss, I think, is one of their big ones, the famous author and podcaster. He's also got a strong network of people, and he's been making some good investments. And I think on AngelList, he lets you opt in to invest alongside him. But even with AngelList product, you still have to be an accredited investor at this point to participate.
Are there a lot of startups getting funding, like, just from AngelList? Like, they go to AngelList and they don't know anyone ahead of time and they get money there? Or is it usually they've already got somebody?
Yeah, okay. That's it. It tends to be the case that they're actually filling out the rest of the round that they're raising.
So they've raised half or a third of what they need. Gotcha.
And then even then, to return to that concept of smart and dumb money, the crowdfunding money is considered quiet dumb money. So a lot of entrepreneurs aren't really excited about raising from that source just now. I mean, if you don't have an option, great, and you can pull it off. But a lot of companies see who their investors are as an authentication process to the rest of the world in Silicon Valley that they're legit. And so if you're accepting money from lots of quiet money, it doesn't really satisfy that authentication. And so people aren't as eager to try it. I mean, it's kind of interesting. I'd love to see some microeconomic analysis of this authentication trust process where, there is this competition from crowdfunding and other sources, but to this day, it ties into the early nature of these startups where there are no financials. How do we know this is good? How do we know they're not just shysters? How do we know they're not just dreamers? And right now, one of the signals that people rely on is who the investors are. And that acts as a signal of quality. It authenticates that it's real, and that helps in future rounds of fundraising. It helps with your hires. If you're hiring employees, it's like, oh, they have money from Reid Hoffman. This has to be legit. So I'm gonna work for them. So it's interesting. It's like, I don't know what that concept would be in microeconomics.
It's that signaling value.
Yeah.
It's like when Michael Jordan is advertising your batteries. People assume, well, they were they were willing to put in enough money to pay him. They must be not a fly-by-night
Yeah.
operation, you know?
Yeah, right. So think about okay, yeah. Think about asymmetric information and a market for lemons. In that situation, asymmetric means that one side actually has more information than the other side. I think in startups, no one has information. It's like, or it's just so scarce, and so they're looking for sources in any way they can, and who your investors are is still one of those sources.
So when there's one thing that we sort of skipped over, I want to just briefly ask you on,
Yeah.
if you've got this idea in the early stage, why go the investor route where you're looking to trade a percentage of ownership in the company for money versus the debt route where you go to, like, let's say a bank and you borrow money from them, and they don't take any ownership of the company, but you have to pay it back. What's the main thing that differentiates those two choices?
That's a great question. I wish I had a very full answer to. I mean, off the cuff, I think there are all sorts of liability issues with loans that can overhang on a company. I think you're going to face a different kind of uncertainty just paying the money back and the interest involved. So with an investment, if you go bankrupt, you don't owe anything.
Yep.
I guess the company could declare bankruptcy, and that would be a way to get out of the loan. But that's a great question.
It's kind of a on the equity investment side, you are cutting into your potential upside if it succeeds. But if you don't succeed, you're not on the hook. On the debt investment side, you are if you succeed, you have 100% of the company, so you don't lose anything on the upside. But on the downside, I think Mark Cuban says you're an idiot if you go into debt to start a company. You should never use your own money. Use other people's money if you can.
Yeah, one of the great inventions of all time is the limited liability corporation. So if you're using other people's money and you're not personally liable for if your idea doesn't work out, that sets the stage for some great risk taking.
So when you at 1517 Fund, would you consider yourself, you're at the venture capital stage, like early?
Yeah, so that's right. We're a venture capital fund. So we have a business model similar to the one I described before, where we're going to make a portfolio of investments, and we need to bring returns to our investors. So it does force us to look at the size of an opportunity a little bit differently from angels. Where we're very similar to angels, though, is that we want to get in, we want to make investments in companies and in people at the earliest stages. So we make investments in young people at the start of their careers, and we're doing it often at, probably this point where they have a little bit of traction. That's the word for revenue or users. They certainly have a team and so on. But yeah, so just to get some jargon out there that tracks the life cycle of a company, the stages we're talking about, it's changing a little bit all the time, but in general, it's like, okay, friends and family is that initial stage where maybe it's a few $1,000s, maybe tens of thousands of dollars, and you're getting started. Then there's something called pre-seed, which would be anything, I suppose, less than 250,000 or maybe 300,000. And then a seed round describes raising money, let's say 300,000 to, I've seen now, $2 million. And then the next round of financing, it would be called the Series A. And then it continues on down the alphabet, depending how much people raise
and
or how many rounds.
When you're looking at companies to invest in, you said you want them to have some kind of traction. So you want them to have a product, or at least a minimum viable product, some prototype version at the very least, have a team in place. And so they already exist. They've got a little bit of traction at least. And then you're looking to invest roughly what amount and for what percentages of companies is there even a general rule?
Yeah, so there's just there are baseline rates that you compare yourself to. It's such a dark art because it's so hard to know you can't value a company if it has no financials, but nevertheless, it's some people, I've heard this phrase, is that the seed stage is about the sizzle, the Series A is about the steak, and what the sizzle is the story behind the company, the team. But nevertheless, it's still hard to set a value on that company, and so what Silicon Valley has done is develop a set of practices to lower transaction costs and try to solve some of these problems. It used to be that in the earliest stage, people sold equity in the company, so stock. But by selling stock, you got to put a price on it, and it's very hard to do that at such an early stage. So what developed in Silicon Valley are a set of instruments and tools that let people postpone these decisions on investment. They get to make investments, but they don't have to solve hard problems like set a price until the company is a little bit more mature. And so what I'm referring to here is called a convertible note. Y Combinator developed something called a SAFE. That's an acronym that stands for a simple agreement for future equity. And so what these instruments do is, let's just take the convertible note. If you're an investor or a company, you can't set a value on it, so you want to postpone that. So what the convertible note does is it is in effect a loan to the company, but it's convertible because it converts into equity at the next round of financing, when there's more information on the company and you feel more comfortable about setting an actual valuation on it. So often at the seed stage or earlier, people are investing on convertible notes. And the investor, though, doesn't want to be totally left unprotected in terms of valuation. So what they do is these notes have some components on them to protect investors or set limits. They're referred to as valuation caps, or caps for short. So what that does is it sets a maximum value that the investor will have to pay per share in the next round of financing. So what you often hear is a company will raise $1 million on a convertible note with a $7 million cap. And what that means is at the next round of financing, the most that the company that those convertible note investors will have to pay is as if the company was worth $7 million. And that'll be really good for them. Let's say that at the next round of financing, the company's worth $15 million. They're paying the price at $7 million, so they've made a lot of they've more than 2x their investment. Does that make sense?
Absolutely, yeah. There's few things more exciting and fascinating to me than the creative, inventive ways that people can structure all these different financial arrangements. I'm always blown away.
Yeah, it can get complicated. The other thing that you'll hear about is a discount. Which also refers to the price per share that an investor will pay in the next round. So sometimes it'll be something on the order of 20%, and that means that let's say I have that discount and you don't. I'm paying 80 cents per share and you're paying $1.
So with your fund, 1517 fund, so it's more than just, okay, we want good founders with a good, good market opportunity and a good idea, et cetera. You actually, it's much tighter than that. You and most VC firms, from my understanding, you have what's called a thesis, which is sort of, it's like your mission statement, and it kind of restricts what types of things you'll invest in based on what you think is your sort of area of expertise. Talk a little bit about the thesis.
Yeah, this is a good way to find investors as well. Going to return to the earlier question. And I mentioned going to conferences. Like, one of the things investors care a lot about is conviction. And one of the things they love to see is just conviction about anything. And so if you meet investors at a conference about, let's say, the future of artificial intelligence, and you have a deep conviction in that topic, and they have a deep conviction in that topic, it may be the case that then they're interested in talking to you about your business idea. That may be related, but not necessarily, right? So one aspect of that is funds typically have a conviction on how they think the future is going to play out. And so they want to focus their investments expressing that view. And if in the list of things you should do before you talk to investors is you should try to figure out what their thesis is that they focus on. And with 1517, since we grew out of the Thiel Fellowship and we have a history of working with younger entrepreneurs, what we want to focus on is not necessarily what, but who.
Hmm.
What would be focusing on an industry or a trend? We are following things, but what we're more interested in is who, and that means you're probably uh, high school or college aged. You're probably a little subversive or outside the swim and in your career so far, or what you want to do. Maybe you dropped out, maybe you stopped out, maybe you graduated, but you didn't find your education that useful, and you're doing something differently. So yeah, we focus on people. We're founder oriented and specific and tied to that age piece as well.
One thing that I've found, and tell me if this rings true for you in your experience, is that if you develop a relationship with someone who is an investor, or they work at a VC firm, even if your idea is outside of what they invest in, maybe they only invest in SaaS, software as a service, and you're doing something different. Even then, oftentimes sending them maybe your deck, your pitch, and saying, hey, could you take a look at this? Do you know anyone? Sometimes they value that because of this thing called deal flow. You guys all need a lot of deals coming in. You need to be looking at tons of deals to make investments. So even if you can do a favor to a friend and say, hey, take a look at this, it might be a good deal for you to look at. Now you've built up a little rapport with them, and they may be willing to send deals that don't fit them your way as well.
Yeah, that's a good thing to keep in mind, and the better relationship you have with that person, the easier that kind of handoff is. I mean, sometimes if you don't know the person at the fund and they're a enterprise hardware fund and you're a consumer software fund or a startup, it could be so far afield that just be careful, or not careful. I mean, you just
aren't going to get anything.
Yeah, but you're right. I mean, it's so true that people are just looking for great deal flow, and they want to help their friends out. Certainly on Sand Hill Road, everyone talks to each other. I know a lot of investors, and I've passed deals on to them that weren't quite good fits for our fund, just because of what we focus on. They've sent people my way. It happens all the time. And then in the due diligence phase as well, funds talk to each other all the time as well. Hey, you're looking at that? What do you think? How do you know them? And so on.
So how do you get deal flow? Because I think in a lot of people's minds, they think, oh, it must be easy. You've got all this money. Everybody's knocking down your door to pitch you. And while a lot of people probably are, a lot of bad ideas might be trying to knock down your door. But there's a lot of good ideas out there. It's almost like if you have a professional sports team, you need to have a whole deep network of scouts and talent recruitment that starts all the way down in high school and through college.
Right.
So how do you do that as a fund? How do you get that deal flow and keep a steady flow of good, good opportunities coming your way?
Yeah, so our experience with the Thiel Fellowship helped us out quite a bit in laying down the funnel for young entrepreneurial talent. The fellowship is still in effect, and that's an independent. I'm now independent from it, but it is still an interesting talent magnet that we will continue to work with. And then just the ecosystem that we created around the fellowship and Peter's Foundation as well, with our summits and other activities. We in our recruiting for the fellowship, we spent a lot of time on college campuses, and now we continue that to this day, because we really want to help people out even before we make an investment. We want to get to know them, even if they're at the idea stage, and we try to throw resources their way. One thing that we've sort of innovated on, I suppose, because not a lot of funds do this, if any. We give out small grants. We give out 1K grants. We'll be on campus. I'll be at office hours. I meet a team or a person who has an idea. But
so you can almost play that friends and family role in some sense.
Yeah, that's what we're going for. And then we'll try to throw resources their way as well. We could introduce them to experts in the field. It could just be back office stuff, or even Amazon Web Services credits along those lines can be very helpful. But yeah, it's like we're constantly cultivating these relationships across America. We think our competitive advantage is that we're hustlers. Sometimes I refer to my co-founder and myself as Lewis and Clark because we're out on the road so often, just constantly meeting new people, exploring. And that's what we have to do to find interesting ideas, because we can't sit back like Y Combinator and receive 10,000 applications. We got to go out there and meet these people and help them out.
What is the typical, if there is a typical percentage in say a VC firm, how many pitches do they hear versus those that they invest in?
I don't know. I don't know a good number on that. That's good.
I mean, it's got to be an extreme minority, I would assume.
Yeah, I think it must be. I mean, you could think of it as a funnel where I know most funds won't even listen to the email from nowhere. So the conversion rate on that is pretty, they must get thousands and then reply to none. I think maybe an interesting example, if you had the number of like warm intros that a fund receives, and then they actually, like, the partners sit down and they hear the pitch, like how many of those do they invest in? I don't know. If I had to guess, I would probably say 1 in 5 or 1 in 10 even. So it's going to be hard. But fortunately, there's a lot of capital out there. So I think, even if you don't get that fund, you might get the next one or another investor. I mean, right now, one of the exciting things about being an entrepreneur right now is that there is so much capital looking for returns. They're desperate for it. There's no way. Like, you look at the global economy, everything is in turmoil. It's hard to get return. You actually have to. You're losing money by holding bonds right now. In certain countries, there's a negative interest rate.
Yeah.
And so there's capital looking for returns. And I think one of the only exciting games in town in the whole world is American startup technology companies. So even though that may be referred to a lot of dumb money or quiet money, or maybe it's not a top tier VC, it is. I think never before in history has it been this easy to raise money for an idea.
So I'm gonna end us here with 2 quick questions for you.
Yeah.
One is, what's the hardest part about being an investor? And then 2, what's something that you wish entrepreneurs knew before they went and sought investment? So in other words, when they come in and you're hearing pitches and things like that, is there a common mistake that you think people should be prepared for?
Yeah, sure thing. I'll start with the second question first, actually. Just there's a standard format for developing a pitch deck that everyone should know. And actually, I don't know if you have like links that you can put up. I can send you a link to. I've written up some notes on pitch decks and have some resources I'm happy to share.
Oh, we'll absolutely put those in the show notes. Yeah.
Yeah, I'll connect that. And so what I wish more people spent time on is actually polishing their deck and practicing their pitch in all its different forms, whether the elevator pitch or the conference room pitch, and really just having it down. And I work with young people, so it's kind of interesting. Is like, because I worked with young people, I just assumed that they were inexperienced, and that's why they were a little awkward in pitching their idea. But then I started sitting on panels for events where there were older people pitching, and I'm just amazed at how bad everyone is. And so what do I mean by that? I mean, like, in some instances, they didn't even explain what problem they were solving. It was like they skipped over the whole product idea. It's like, whoa. So and what I mean by formats to the deck is, like, there's a typical order. There are key points that you have to hit and explain. And so everyone should have that in the background no matter what. And it's always helpful when it's like you just know someone has thought through the problems. And it's a clear indication about how far along they are on their idea. Remind me again what the first question was.
What's the hardest part about being an investor?
The hardest part about being an investor was, you touched on it, was the deal flow, making sure that you have a constant stream of great ideas, because you're building a portfolio. You want all of it to have the potential to be good. I think the key thing that most investors regret is actually passing on something that became big.
Yeah, I've heard that many times. Yeah. Investing in something that fails isn't nearly as painful as
that's
not
gonna
investing.
happen,
Yeah.
right? So with my own experience, yeah, I'm not concerned about actually sitting down in a pitch meeting and passing. I mean, that could happen. I can't wait for in the emails. Danielle, my co-founder, and I, when we do pass on an opportunity, we've added a sentence a few times. We're like, look, we know this is, you could rub this in our faces one day, and we hope you do. It's like, because it's just so hard. But my biggest fear of all is actually I don't even get the pitch meeting. Is that the person is just so far outside my scope and never thought to talk to me that I don't even get a look at all. So that's the hardest thing, is like, am I even seeing? It's like, it would be heartbreaking if I heard the pitch for the next Facebook or Uber and passed, but I think it would suck if I knew I could have met this person and I didn't even get I didn't do it.
Michael, thank you so much for taking the time to join us. Michael Gibson, again, he's a general partner with 1517 Fund, 1517fund.com. This has been really, really awesome, really informative.
Cool.
And,
I hope it's helpful for your listeners. I really enjoyed talking to you.
Absolutely. We'll talk with you again soon.
All right, Isaac, be well.
See ya.